What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies. And if you stick with me towards the end of the video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. One of them happens to be AMD, which I know is a fan favorite. With that being said, we've got some t-shirts left in stock. So if you're interested in picking up a t-shirt, it's the first link down below in the description. I believe most of the stock left is in the large size, but if you see this size bubble available, that means that the shirt is available. So get them before they're all gone. Remember that we will not produce this same design ever again. It's kind of a one-time deal just to celebrate that 25K subscriber mark. Some people already received them on Saturday. The feedback has been fantastic. Thank you, thank you, thank you. If you have already ordered a t-shirt, I genuinely appreciate the support of the channel. And if you'd like one, again, a couple are left, tradebrigade.co/t-shirt, or just the first link down below in the description. With that being said, any other resources that we're associated with are linked down below in the description as well. And without further ado, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this week, we certainly have a small-bodied bullish bar. I would not classify this as an indecisive doji. There's really 2 main reasons for that. Number 1 is that the closing print was fairly far away from the opening print. A doji would really have a closer open and close, something like this, or potentially like this. And of course, we can see a slight difference in terms of this past week's structure. And then the second reason is just the fact that the upper and lower wicks are not really substantial in size in relationship to the overall candle body. So it's less indecisive and more just a slowing of momentum, if you will, which is exactly what we outlined in last week's video and a perfect segue into location. Now, yes, on a bar-to-bar perspective, a defining characteristic here is the fact that we have such a substantial higher low. That does strike me as a bullish implication here. We do have on a bar-by-bar perspective a slightly higher high, but most importantly, we've neutralized the weekly trend, right? We're finally home, so to speak, up at this prior high from in here, and no longer do we have high, lower high, lower high. This could have produced a lower high here, but you can clearly see now we have the equal high. So the weekly trend has neutralized. If we think about prior patterns as well, and this ties directly into location, we had been monitoring this head and shoulders pattern, right? And we knew that the neckline was kind of right in this area. So we've already back tested it once, break, retest, and then we got a leg lower. And now we're coming into that neckline again. But I think we should think about the neckline in a different sort of perspective. If we were to get a pullback, does it form an inverted head and shoulders neckline now? And can it be a bullish breakout point? To me, the answer to both of those questions is absolutely yes on a higher low pullback. So that's just something to be mindful of here on the weekly time frame. And I'm not saying it's going to happen that way, but it's something to just be aware of if we start to see a pullback. Now, another reason why the slowdown kind of makes sense here is because we know that markets like to move from high volume node to high volume node. And again, we're kind of quote unquote home at this next high volume node. So will we chop around? Will we go sideways here for a little bit? Will it produce a pullback? All of those things would seem reasonable to me at this area on the weekly time frame chart, just based on the high volume node. If we were to get continuation over this neckline, where's the next high volume node? You can clearly see that would take us much closer to 440. Now, I'm not making the argument that we go there this upcoming week, but I'm pointing out if we move from high volume node to high volume node, which is what we've done so far, we've went from this one up to this one, the next one is 440, right? Just using these things as stair steps, if you will, and clearly defined upper and lower targets. If we roll back over, of course, we would want to see a higher low above this high volume node, but would it be the end of the world to go back to this 390? It would be on the weekly time frame a back test of the breakout of this balance. It wouldn't be the end of the world, but it certainly would not be ideal from a sort of reasonable pullback perspective. I also don't really think that we're going there unless the CPI numbers are absolutely horrific come this Wednesday. The reason for that is because, as we discussed earlier, this to me strikes me as complete bullish digestion, clearly in the upper third of the prior week's range, which was a nice solid momentum bar to the upside. Will this turn into a 1, 2, potentially 3 bar pattern? Possibly. Possibly. So let's drill on down to the daily time frame though and start to look at some more evidence that's more pertinent to day trading. What are the levels that are in play here? I'm going to pop on the 50 and 200 SMA. 50 is in blue, 200 is in green. Let's zoom in here a little bit and go through the steps that we always go through. First one is the weekly expected move. So if we are to contain ourselves within the weekly expected move here, you can certainly see that it's very likely we will produce a higher low or a higher high. So from the daily trend perspective, things are all good here. There's no real concern, at least based purely on expected move, that we're going to see that weekly collapse that I just outlined to the top of the balance area here, roughly 390. That would not strike me as being a reasonable possibility. Again, unless the CPI numbers are absolutely horrible come Wednesday. We're not positioning early for that. Don't misconstrue what I'm saying as, hey, let's be bearish and get puts early in the week expecting Wednesday to be bad. That's not how you play it. That's not how you play it, okay? So weekly expected move keeps us in an uptrend from the daily perspective. We have lows, higher lows. If we pull back to here, obviously that could produce a higher low and we can be on our merry way from there. Let's talk about levels. The buyers are still clearly in control, but I do want you to be aware of all of this overhead resistance that we're kind of running into. So we had a 3-day balance from right here. We broke out, we consolidated above, confirmed this as support, and then we were back under on the Friday session. So overall, this is an area of resistance, 413, 50, 415, 35 from in here. And then if we look left a little bit further, this is where a breakdown came from. I suppose I can illustrate that on an hourly time frame chart here, zooming into this. Remember that it was a breakout point for there, and then when we broke down, we have not looked back since. So 418.50, that's where that number is coming from and why it's substantial. I think there's a number of things that are just overhead resistance here, which might make some upside tough. So be aware of that, but once we can clear 418.50, that's where the range opens up into that 428.65. So if we get further consolidation into a bull flag in this general area of resistance up here, it would not strike me as overly concerning. That's what I've got from a levels perspective to the upside on breakdowns of 408.25. Of course, support for the higher low wants to come in at 402.80, and then underneath that here at 395.75, that may coincide for a super support with our 50 SMA. Those would be the pullback levels. Again, to me, we're neutral. We're inside of this choppy zone right here. I would also give the context of a bull flag, right? It would be hard to be bearish on this pattern. And this sort of ties into the next piece, which is psychology. On Friday, what happened, right? On Friday, we got a gap down with the jobs numbers coming in. And this is where the sellers should have materialized if the sellers were going to make a stand here and send this market lower. So we open on the momentum from the gap down, but what happens? There's buying activity all day. All day, we produced higher lows. Again, the hourly time frame might be useful here just to illustrate that. Let's go on over. So we open on the gap down, we fill the gap immediately, higher low pullback, and now we're just, sort of flirting with the top of this prior 3-day balance once again. So if the sellers were truly strong, why was it that they couldn't get any activity underneath the opening print from Friday? I'm just still not seeing the case for sellers being strong and producing any sort of major sort of market pullback at this point in time. Now, is there risk for liquidation break? Absolutely, and we should discuss that now. Many people are drawing parallels between what's happening here and what was happening right here. We would call this distribution, right? This is confirmed distribution because we did end up moving lower. Now, what we have is fairly interesting, right? If you think about the number of days that were here, it was 8 days, and then we got some economic data and we collapsed. If we go Monday and Tuesday, that would produce 8 days. If Wednesday comes out and we get some economic data that's horrible, maybe that does produce some sort of liquidation break, but again, the structure is different. Look at what's already happened so far. We've confirmed an anchor low. We've confirmed equal lows, and we've already moved on to produce a higher low, breaking out clearly and confirming this as support of the ascending triangle, right? This kind of pattern right here. What did this look like? Certainly just a double bottom. This is not nearly as strong of a pattern as what we see here in terms of reversal for all of the reasons we've just discussed with the higher lows. And this was already flirting with the breakdown of the neckline of the double bottom. So structurally, it's different. And I think that, based on the psychology of the sellers that we just discussed on the Friday bar, I'm not overly convinced that anything major is going to happen just yet. Now, again, on CPI release come Wednesday morning, things can change on a dime. But the key takeaway is that we are not, I'll say it 3 times, positioning early for some type of move that we think might happen there. So that is what we're mindful of here on the SPY daily time frame. If we quickly scrunch up the chart and remind ourselves of the Fibonacci's as well, coming in from the all-time high down to this most recent low, you'll notice that all of this past week's worth of trade was acceptance above your 38.2, which is slightly bullish, right? If this was going to be a bearish chart, we would have rejected at the 38.2, or we would have just fallen back down underneath, and this constitutes bear territory. You can clearly see we're moving away from that. A couple other fib perspectives that I want to share with you. If we come in from the low up to the high, obviously we're well above the 38.2 from that perspective. If we come in from this low to this high, well above the 38.2 from that perspective, which is bullish. And even if we take the shortest measurement here, we are still above the 38.2, which of course keeps bull flag consolidation in play. Even if we were to pull back and move into the 61.8, which is technically a little bit deeper than we'd like on a pullback, we're still respecting, as it would seem, this prior high here and roughly that 400 round figure. So to me, there's no real reason to be overly bearish in the S&Ps until we breach the 61.8 and this prior higher high right here. Ideally, we could produce a 395.75 higher low, but we're kind of flirting with too aggressive of a pullback at that point in time if we come into this area from a day trading perspective over the course of this upcoming week. So that has been the S&P 500. Let's take a quick peek through our sectors and see how the trends are continuing to develop in the individual components, if you will. So the XLE is playing nicely, coming back down into range. Remember that this is D for defensive. We do not want to see it leading the charge, and it pulled back after it made this high above the prior set of highs there, which strikes me as a good sign for the marketplace. So no big concerns in energy. Lightweight sector defensive, moving on, is playing nicely. The XLF is looking pretty good as well, right? Technically, we've got this balance area, and it's above the flag breakout area. On the Tuesday session, we technically move underneath the top of the prior flag, but look at what happens into the end of the week. All of the consolidation is above. Now we're looking to see if we can get continuation over 33.73. As long as the XLF is above 32.45 in the grand scheme of things, we're A-OK here on the daily time frame chart. So this strikes me as bullish support for the S&P 500. XLB materials, lightweight sector, we're not going to spend too much time. The main takeaway is that the inverted head and shoulders is very much in play with a break and retest of the neckline, rallying slightly higher on the Friday session. See if you can get continuation over that 50 SMA for slight bullish pressure for the S&P 500. XLRE, real estate, another lightweight sector, but it is D for defensive, so we'll take a quick stab at this one. It's pulling back, but it is firmly above this prior sort of consolidation range, if you will, right? So if you draw in thirds, we're in the upper third. It doesn't strike me as overly concerning. As long as this is not making new all-time highs, like back in this area up and over the 50 handle, I wouldn't, be overly worried about what's happening in the real estate sector. If it rallies higher, sure, it's bullish pressure for the S&P 500, but it will not save the day if the XLK, if the XLV, if the XLF, XLY, if all of those are bearish. Of course, real estate being lightweight will not come in and save the day. Just like if this is crashing here in real estate, it's not going to drag the market lower if the heavyweight sectors are really pulling their weight. Continuing along, XLI, 7% of the S&P 500. Beautiful bull flag up here, respecting this area of support around 94.50. As long as we're above that, there's no argument for the bears whatsoever. If we break down underneath, sure, higher low pullback, very likely around this 90.54, just basically the top end of this prior breakout point. Doesn't strike me as overly concerning. If we do get continuation, watch out for 98 and your 200 SMA, which of course would be good bullish pressure for the S&P 500. The pattern looks phenomenal. XLV, this is where we've got to do a little bit more explaining. Of course, we have that monthly inverted head and shoulders look. The neckline is up here around 133.50. If we can take it out, I would expect a rotation to the top of the range. Remember also that that's kind of a monthly range. Here is the balance area. We have the look below and fail still in play. Target should be the top of the range eventually. Doesn't have to happen immediately, especially when we're sort of referencing monthly ranges, if you will, right? And overall, just like the XLF, I like the fact that this consolidation is happening above the bull flag consolidation from here, from this perspective, right? And on Friday, on the gap down, again, across most of the important sectors, the gap down did not produce any substantial selling. We closed the gap and we close closer to the midpoint of the range instead of weak down at the lows closer to 130.50. So to me, bulls still firmly in control here, consolidating sideways. We still have not breached any of the highs of this container bar. Notice that all of these are technically inside bars of that big hammer that we just pointed out. So to me, again, it's just neutral here, slightly bullish just based on the trend, right? So lows, higher lows, higher lows. Are we going to produce a higher high is the next question for trend continuation. XLV being the second heaviest weighted component of the S&P 500 strikes me as being in the neutral to bullish category for the S&Ps as long as we're above 130.50. Moving along, XLP. This did produce a hammer candle on Friday's session on the pullback. So to me, again, failure from the sellers to really materialize lower. The close was not weak. We closed back inside of this multi-day balance right here. Although, yes, it is right on the lower edge. Again, just if the sellers were stronger, we would have closed weak, or we would have just come in for the back test of 73.20. You can clearly see it didn't happen. There are also a number of bullish setups out there in the consumer staples stocks. Many of these are going out in the Swing Trade newsletter, which is linked down below in the description if you're interested. But overall, those bullish patterns should lead to a break of the hammer high and a rotation back to the top. Of course, this is D for defensive, so we don't want to see it leading the charge, making a leg up into 78, but moving towards the top of the range here early on in the week would be bullish pressure for the S&P 500. Continuing along, XLK. What's going on in the tech sector? Again, it's hard to be anything other than bullish in all of these charts. Could we experience pullbacks? Yes. Is there risk for liquidation break? Yes. But are we shorting based on the assumption that maybe something will happen? No, absolutely not. Again, look at what happens on Friday. We gap down, we close the gap, and we close firmly inside of the Thursday range and up at the highs of those two bars, right? So to me, the buyers are in complete control here. The sellers, if they were going to make a stand, had their opportunity on the gap down. They did not materialize whatsoever. And I'm just not seeing any evidence whatsoever of sellers being firm in this market. Now, the flip side of this coin, right, is are we chasing new money longs up here? Ideally, no. I would like to see a little bit more consolidation, something that helps from a risk-reward perspective. And also, again, remember this, that we have resistance from a triple top right here at 148.56, this being the heaviest weighted sector of the S&P 500. That's why we're diving in here. Excuse me. So reward to the upside slightly limited, whereas you can clearly see the pullback might take us to here. You don't want to really be trading for inverted risk reward. But again, there's no reason to short right now, which is why we're not advocating for shorts up around this area of resistance. I think CPI might just be the sort of binary event that will either push us over the edge one way or another, but it's too hard to position for that early. So XLK, the chart structure is completely bullish, but the risk reward is not necessarily there for continued upside. Just be mindful of that. And yes, I will completely acknowledge that volume is tapering off as we're quote unquote climbing the wall of worry, which is just one more reason to be slightly more cautious, but still maintain a bullish stance on the structure here in the XLK. Continuing along, XLU for utilities, D for defensive, sort of not really playing nicely. Like energy obviously pulled back aggressively here and did get some continuation lower back into this range. Utilities, we can only do so much. Obviously, we've got to deal with the hand that we're dealt. As long as we're kind of underneath 75.29, okay, not the end of the world. If this does continue, though, and just start seeing aggressive strides to the upside, not really ideal from a risk on, risk off perspective, right? So keep a close eye on utilities. This might be one of the early red flags that a market pullback is coming. So if the utilities start really taking off here and the XLK stalls out at that resistance, if the XLV can't break out of the consolidation, if the XLF can't break out of the consolidation and utilities are rallying, that's kind of your red flag to say, all right, let's take our foot off the gas a little bit in the S&P 500. Continuing along, XLC. Communication sector really not playing nicely either, right? A little bit of a red flag here, noting that we did break on Wednesday firmly that 57 level that we had been discussing for quite some time. It took 4 days of consolidation, finally broke and closed above, and now we're kind of right back around that area. Don't get me wrong, on Friday, the psychology was there to sort of close the gap, but look at where we've closed, right? There was more of a gap fill reversal and pullback on Friday in the XLC as compared to some of the other things that closed more firmly inside the prior day's range. So communications, still a bit of a thorn in the side of the S&P 500, being the fifth heavyweight sector in the lineup here. It'd be nice if this could just get into gear and really start pulling its way above 57. This double top should be carried forward as weak. If we reattempt that, obviously off of a higher low here, I would expect that to break, especially on a retest in short proximity of time. That would be bullish pressure for the S&P 500, but we have to get there first. We have to get there first, and the Friday structure is not as bullish bullish as what we've seen in some other sectors so far. So just be mindful that there's a trade here potentially up and over this 58.18, but as of right now, the structure would suggest that maybe sideways is more of a likely outcome instead of some sort of breakout. Okay, so neutral, I would start to get bearish in the XLC if we were to break the support trend line. As long as we're above that, it's hard to be at least not neutral. If we do crack it, though, that's where the sort of bear outcome develops, and maybe we can look for some downward pressure in the S&Ps. Anyways, XLY, last but not least, heavyweight sector, climbing the wall of worry, not as convincing on the gap fill, right? We do have a gap fill reversal on the Friday session, but remember that we have a gap underneath us, which is unfilled. We've been up very, very aggressively here. Can we afford a higher low pullback? The answer to that question is absolutely 100% yes. If the higher low pullback comes, I mean, it'd be ideal if it happened something like this and then turned around, but in reality, we could come in for a back test of 157 and it would be A-okay, repair the structure, fill the gap, and then bounce out of that. If you're looking for short trades in the XLY, I would carry forward these two lows around 162. If we crack 162, the inverted hammer lows, that opens up the door for the gap fill, and you would just know that we have bearish pressure for the S&P 500. All right, so that's what I've got from a sector perspective. Let's take a quick look at our sector ratios. So bear with me as this loads up here. If you're interested in setting this up, link in the top right-hand corner. What do we have from the ratio perspective? The top four are our risk on sectors. You can certainly see that the XLK is screaming to the upside. That's risk on. XLY screaming to the upside, right? From a trend perspective, higher lows, higher lows, higher lows, higher high here. Can we afford the higher low? Yes. So screaming to the upside. XLV needs to get back in gear. This one is not really confirming as of right now. So we'll put an X in that box. And the XLF is really, I would say actually that this is an X as well. It's certainly trying to get into gear. You can see that perking up off of the lows right here, but 2 for 2, half sort of split, if you will, is not enough to be fully risk on, but we're trying, right? This is more of a neutral indication as opposed to risk on being completely off, if you will, right? So this is more neutral, having 2 on the bullish side and 2 on the bearish to slightly improving side. Really want to see that XLF get in gear. It has not been in gear for quite some time as we've been marking this market turn. If this one can perk up a little bit, I think that does start to change the tone ultimately out there in the marketplace. Down below, the bottom 4 are the risk off sectors. And what you'll notice here is that risk off is actually slightly off, right? This is all looking good down here. The XLP is sideways. It's not really aggressively rallying higher. So that's a good thing for risk off turning off, allowing risk on to turn on. I know these terms can be slightly confusing. Maybe I'll make a video someday. But energy down, right? So this is a good sign as well. We want that to be moving lower. XLU tangled up sideways around that 50 SMA. That's the gold line. It's not ideal, but it's better than obviously pointing clearly higher. So we'll put a tilde here. I suppose maybe this one gets a tilde as well. And then the real estate sector is pulling in a little bit back into this sort of range here. So again, that's more of a neutral indication. So I would say risk off is still currently in the off mode, allowing for some room and strength to come into these sectors, but we need that XLF to really perk up here for risk on to be more definitively on. Anyways, the main takeaways, if you just want to keep it simple here, is that we're really still in between phases, if you will. We're not fully risk on, but we're also not risk off. The market does appear to be more in a neutral territory right now as we've been making the market turn. So anyways, that's what we've got in the ratios. Hopefully that was helpful. It's been keeping us on the right side for quite some time. Let's take a quick peek at the TNX, which is the 10-year rate. What I want to point out about this is, and briefly talk about, is the CPI come Wednesday. You guys really liked when we did the in-depth dive the other day. So just from a charting perspective, then we'll talk CPI. Obviously, we're still in this box. We're perking up off of the lows as that jobs number came out on Friday. And I guess that's just a great segue. So from a technical perspective, neutral, sideways, not really doing anything impressive here. Technically speaking, yes. Head and shoulders, are we underneath the neckline? Not anymore, but we're also not aggressively over this right shoulder, trending higher towards the head of the pattern, which does not strike me as concerning. Briefly, before we get to the CPI stuff, right? If this is trending higher, it's downward pressure on the XLK, XLK being the heaviest sector in the S&P 500, not really a bullish indication. If this is sideways to lower, means the XLK can rally higher without too much headwind, and that, of course, is a bullish pressure for the S&P 500. So that's the correlation just from a technical perspective. Let's talk about CPI now. On Friday, the jobs number came in better than expected. That means that the market should be able to withstand another 75 basis point rate hike. We also know that the path going forward to what was last mentioned from Jerome Powell in the SEP as being the target rate is either a 75 again and then two 25s, or two 50s and then a 25. So with the jobs number coming in good and allowing some resilience for the market, it might be in store for another 75 basis point hike. Okay, so if CPI is hot, expect 75. If CPI is fine and inflation actually ticks lower, maybe we're on track for 250 basis point rate hikes, and we can go from there. I would imagine that the market likes that. If the CPI finally ticks lower, that would probably be a good thing. I don't want to hold my breath on that. Obviously, good news can be bad news. The market can do whatever it wants, but that's the rough interpretation of what's going on with the economic data. A little bit fundamental for our perspective, but it is nice to know what's going on. The new target rate forecast did jump when the jobs report came out on Friday. However, remember that Jerome Powell has not spoken to us yet, and the last thing that he said in his press conference was that he liked the SEP's statement of economic projections with no revisions in the last meeting, which is something that was uncommon for him. That was the first time that he has said something like that in quite some time. So to me, I'm not necessarily sure that we should be overly confident that the forecasted rate should reflect this new interpretation from the market without confirmation from Jerome Powell first. Remember also that there's no Fed meeting in the month of August, so we need to wait until September for some more data to come out on that front. Regardless, a little bit fundamental for our perspective, but that's what I've got for you. You guys did seem to enjoy it last time we did it. VIX is up next. What's going on in the volatility front? Trickling down towards that 2050 level. That, of course, is where we know that the market's a little bit more content. We're obviously firmly outside of the box of wickedness, if you will. We've got a couple of break and retests, so 1 and 2 here, clearly rejecting around that 2450 handle. Strikes me as bullish as this comes in. Obviously, it moves underneath 2050. The market is more content and capable of grinding to the upside. If CPI comes in really hot, maybe this ticks back up. Something that you would watch here is, do we return back into the box of worry, box of wickedness, as we've been calling it, which is over 2450. If we're back over 2450, be prepared for a bumpy ride. If CPI comes out and we just kind of do something like this, no big deal. Let's take a quick peek at the VVIX, which of course is the volatility of the volatility index, indicating still that no one is buying puts in the S&P 500, no one is buying calls in the VIX. So if CPI is absolutely horrendous, inflation continues to fire out of control, but in a massive way that the market might not expect, no one is hedged properly. That may lead to a little bit more of an aggressive pullback than we might imagine, just based on no one being properly hedged. Again, would I position early based on that? Absolutely not. Absolutely not. Absolutely not. That is the one thing that we advocate for here at the Trade Brigade. Do not trade based on news or what you think might happen. Just trade the price action. This would just indicate to us that if a breakdown occurs, maybe we can take advantage of that trend for longer than we may have thought otherwise. So anyways, that is the VVIX. We'll quickly get on over to the market internals. I've got a video for you on how to set this up and what it all means in the top right-hand corner. The main takeaway from this screen is that as we've seen a week's worth of balance, essentially, we've gone sideways. We haven't done anything really. The internals would just completely confirm that, right? No major red flags. None of the volume reads have even scratched at plus or minus negative or positive 300 million. So volume has been fairly light on the inflows and outflows. Nothing major from that perspective. The advanced decliners really getting most of the activity around or near the zero line, fading off the extremes every single time we've opened up near them. Very, very neutral of an indication. Ticks, same thing, kind of all across the board here. Definitely a little bit more bullish as you can sort of get the summary from the cumulative down at the bottom, but no overly aggressive reads one way or another, or domination from one side of the trade. They were really more compressed as we sort of saw throughout the majority of the week. So confirming balance, no major red flags, nothing about this would really strike me as something that we should point out as concerning. Next up is the market profile. If you're not familiar with this, again, I've got a video tutorial explaining some of the terms here in the top right-hand corner. The main takeaway on this is that the point of control from Friday was actually higher. Point of control from Friday was actually higher. So what does that mean? Well, again, if the sellers were going to be strong, why? Let's talk about it from a pattern perspective first. So this multi-day balance, look above, technically fail as we open underneath. Why were the sellers not able to rotate to the bottom end of the range? That's the target on a look above and fail. It didn't happen. Where was the point of control at the close? Right back at the top of the balance. To me, that's a pretty bullish implication and a massive failure from the sellers. So again, from that psychological perspective, I'm still not seeing any case for the sellers to completely come out and dominate early on in the upcoming week. Now, if we break the bottom of the 3-day balance, yeah, I suppose we can move lower here. It wouldn't be unworldly. And we also have some virgin points of control to start targeting on the downside. The first one is this one right here. That's roughly 40.95. After that, to the downside, we have this right here as the next VPOC. That should be your target, right? That's many points lower. That's 40.73. Excuse me. The next one is many points lower, as this really frustrates me and does not want to cooperate. There we go. So the next one is many points lower. This is about 100 points lower here to 38.75, 38.75, 38.92. What am I saying? That is the next point of control. That's not, geez, this thing really threw me for a loop. My apologies, guys. I'm trying to reorient myself. There we go. So that was a little bit of a doozy there. What I was trying to say is this point of control to this point of control is about 100 points worth of difference. So this is really where the largest of the breakdowns can occur from roughly, what was that? Would we say 40.75 down to 39.75, right? So that is really, if a big breakdown does come, that's probably the thing, quote unquote, the thing that you should be trading for, right? A move back down to retest this naked point of control. There we go. Apologies for the mix up. Sometimes the software does not want to play nicely, but that's what we've got. Just to sum it up, point of control from Friday, bullish implication, big failure from the sellers. If we get a breakdown of the multi-day range lows, that's this area right here, 39.75 is quite a ways lower as the major target underneath 40.75, right, which is the bottom end of this balance right here. So that's the case for a breakdown. Hopefully that wasn't too confusing with that little mix up with the tech, but let's get back on over to the platform and round out the rest of the broad market. Thanks so much for sticking with me. Just as a quick reminder, I guess we'll throw it in there one time, that t-shirts are still available. If you have not picked one up already, tradebrigade.co/t-shirt, first link down below, and you can scoop one up before they're all gone. QQQ, very much so relative strength, right? That was worded quite oddly, but the reason we say that is here's the 3-day balance. On the Friday gap down, we did not gap into the balance area. That strikes me as bullish, big relative strength, right? And now we've closed back inside the Thursday range, and we're looking for some follow through to the upside. So if we can breach this, obviously the top edge of the weekly expected move coincides beautifully with the triple top from in the past. If and when we get there, I would expect some sort of pullback around 330. If it produces a higher low and the trend is like textbook here, we have all of these beautiful higher lows respecting the prior highs, so on and so forth, then absolutely that's going to turn into a breakout point. Would I look for it into this upcoming week? Again, I wouldn't position early for that, but it could be a possibility up towards the top of the weekly expected move. If CPI is horrible and the market does move lower, where are the critical levels that we want to see hold as support? Well, early on in the week, as long as we're above the 3-day balance, that would keep us optimally bullish. If we rotate back into the 3-day balance, breakdowns want to hold 302. 302 would produce a higher low above this kind of shelf of breakout and prior support here. So on the weekly time frame, that of course would be a higher low, right? You've got this, that produces a higher low. Getting here produces an equal low, which is not an ideal outcome for this chart going forward. So just to recap here, the bulls in complete control, relative strength in the QQQ, looking for a breach of this to get into that 330 target. This is a very important level in the QQQ. If we break down, I would be neutral in the 3-day balance area here, and breakdowns of 311 can produce a higher low to 302. If we bounce off of it, obviously that is well below the bottom edge of the weekly expected move and would probably require a catalyst to get there. That's the bear case if CPI sends us much lower, which one more time I'll repeat, we are not positioning for early. From a Fibonacci perspective, just to stay congruent here, from lows to highs, well above the 38.2, from this low to this high, well above the 38.2, and from this low to this high, you can clearly see well above the 38.2. So fully in control from the buyers right now. We're all in healthy bull consolidation territory. Breakouts do look good and are the favored outcome here, unless there's a freak accident with the CPI. Next up, we've got IWM Russell 2000, the small caps, really just more of an indication for the broad market overall. Outside bar on the Friday session, which is unlike anything that we've seen so far in the broad market. This has incredibly bullish implications. Not only did we open on a gap down where the sellers should have had the upper hand, we closed the gap, we moved through the entire prior day's range, and then we closed strong firmly at the highs outside of and to the upside of the prior day's range. So bulls firmly in control, flexing big time here in the IWM. Can we produce a higher low pullback? Yes, that's still fine. Can we consolidate up here? Yes, that is still fine. If we were to breach these two highs and the high from Friday at 190.71, our upside is all the way up towards 196.50 without very much interruption. There might be some kind of a hang up here around 193, but overall, the larger area that's in play, if I just adjust this slightly, my apologies, is this breakdown point from here around that 196.50, right? That's kind of where the quote unquote scene of the crime is, and IWM should be headed on a break of this level. So many more bullish implications here in the IWM. Things strike me as being in control from the buyers. Without taking out the fibs, I'm sure you can imagine that we're above the 38.2s across the board here. So that's been the broad market. Let's get through the core list of companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that, we'll kick it right off with Apple. We spent much longer than we thought on the broad market, so very, very quick and simple in the core list here. Apple, 3-day balance. We are accepting above bullish implications based on that. If we crack the multi-day highs here, 167.50, look for upside into 171 coming from this prior rejection point from right around in here. Downside in Apple is achieved if we breach the top of the 3-day balance highs at 163.25, in which case we're targeting the bottom end of the range at 159.50, and also a little bit of continuation to close the gap down to 157.65. So that's up and downside in Apple. As of right now, bulls in control outside of the 3-day balance to the upside. Next up, we've got Netflix. What's going on in Netflix? The pattern is still very much in force here. Bull pennant up against this 228 level, looking for another attempt to get back above it, right? We had a bit of a suckers rally on the Thursday session. We pointed that out, that we were waiting for a break and retest because it was such an obvious setup, and that's still what we're watching out for if we can get back above 228. Let's confirm that as support before we start having more confidence about this breakout here. The reason it's still on the table, of course, is because we are continuously respecting this support trendline. If it breaks sideways through time, not the end of the world. Shorts in Netflix are only produced underneath 221 roughly, because you have all of these longs who are disappointed on the breakdown of that for the new lower low. You get some support at 215, but ultimately the rotation can be here to this big prior breakout level around 202.25. Next up, we've got Tesla. What's going on in Tesla? Of course, the split is coming at the end of August. We've been breaking down on Friday outside of this 4-day balance, but we've caught ourselves at a very nuanced place. No, that is not a random level at 865. If we quickly flip on down to the hourly time frame, you can see that's where the breakout came from on that prior Friday session. So what does this mean going forward? If we produce a higher low here and we can get back above 886.35, technically speaking, we have a look below and fail. Target should be the top end of the range at 934.50. That is a bullish setup. If we continue to dribble lower, I wouldn't be overly bearish in Tesla yet until we break down underneath 841.25. If that were to happen, the target's here, the midpoint of this prior range, and the failure to hold this prior high, right? So consolidation, then a break here, gets us to 808. Again, where is 808 coming from? Might seem like a random target in there, but if we go to the hourly, you can see clear support, then flush, and a breakout point that held there on some of these prior days sessions. So that's Tesla in a nutshell. As of right now, I'd be a little bit more neutral early on in the week, waiting for one of two things. Which box do we move back into? Do we go here, in which case the target's the top, or do we consolidate and break down, in which case we talked about 808. Next up, Google. What's going on in the Goog? You can currently see that we're hanging out towards the top of this balance range. 3 days of balance in play. Obviously, 118.75 is your breakout point to target 122.50. If we breach these lows, look for rotation here. It's not really that bearish if we would see a pullback here off the top of the balance range, 113.85. If that holds, bullish consolidation up here at the highs, ultimately putting in some sort of bull flag that would look like this. The bear trade really unfolds if we give up 113.85. That's where we can rotate much lower back down towards this gap down here. So overall, bullish outlook here inside of Google. Ideal if we stay here for the breakout, not the end of the world if we stay here for the breakout, and if we breach this level, of course, look for some deeper pullback. Next up, we've got Meta. This one is slightly concerning with the inverted hammer that printed on Friday. Sure, it was inside the prior day's range and it didn't really produce a major gap down like some other things, but nonetheless, this is not really promising price action for upside at the top of a range. I would be neutral in this overall zone right here around 166 down to 163.75. If we remain above, fine. Breakouts are still on the table, and of course, we are looking for this gap to act as our major trade sort of setup and and logistics, if you will, on the upside, 175.50 up to 178.87. That's on the break of 172.56, right? So consolidation, then a break, that's kind of in play. If we breach this sort of neutral zone here, the bottom end of the range will come back into play off of a lower high. And to me, this is an attractive area for shorts to the downside underneath 155.50. Of course, that requires some patience. It requires a breakdown first, but the setup is there, just noting the relative weakness in communications. Next up, we've got NVIDIA. What's going on in the chip making space? Look at this nice healthy consolidation outside of the 3-day balance range, just like Apple. Neutral here, breakouts over 192 get us to 200, breakdowns target the bottom end of the range, and I would watch for firm support around 180, 125. If we break through that, your next level is 174.14, but based on the structure of this current chart, I would expect this to be a pretty solid support, and the short trade would really just be a scalp on the look above and fail. Reassess the chart when and if we get to 180, 125. Microsoft up next, bull flag on the daily time frame, 3 equal highs, maybe 4 if you want to count this one from back in the past, 283.15. If it breaks, we're looking for higher into this big pressure cooker top on the daily at 291. If we were to get there, I would expect a higher low pullback, and then there's a little bit of a gap unfilled from here to here up towards 296.45. Chart is pretty bullish here, getting firm acceptance outside of this prior range. You could even draw it in like this, breakout, right, and acceptance above for a bull flag, 3 equal highs, boom. We talked about upside. I would not be bearish on Microsoft until we breach 273.50. If that happens, back test of the breakout point from here is the target at 267.25. Last but not least, the mini beast, we've got Amazon. What's going on here? Completely bullish chart as well. A lot of acceptance outside of the 3-day balance range to the upside after the earnings cycle. Inverted hammer on Friday, absolutely. So if we breach the 2-bar lows in there, let's zoom in on that a little bit. If we breach these 2-bar lows, definitely target the top of the range here at 137.58. That's like a very quick intraday scalp, right? And then if we fail back into the 3-day balance, yes, look above and fail. Technically speaking, you could target 132.50 and then see if this gap comes into play. But I would not short early just based on that, right? I would not, to me, and I'll just be completely transparent here, I'm not looking for short setups until we breach this level and start moving into the gap, right? Can you technically trade it based on a look above and fail? Absolutely. But for me, I want the confidence underneath 132.50 before I start aggressively taking shorts. Let's get into these ideas. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, and grab a t-shirt if you'd like. First link down below in the description. Let's get right into these trade ideas. First one is on AMZN making a reappearance here. Certainly the possibility for a 1, 2, and 3 bar setup if we can breach these 2-bar highs. We get a nice trend and aggressive momentum bar to the upside. 2 is a nice consolidation bar in the upper 50% range of that bar. If we breach the highs, looking for continuation into, look left, this prior set of resistance. So let's mark off some levels here. 109.30 is the target on the breach of 104, we'll call it for round number's sake, and we would ideally like to see this chart remain above 99.36, call it 99 even. As long as we're consolidating here, the trade is still in play, looking for that upside. If we breach this to the downside, not really as attractive for long. So AMD looking for breakout and continuation here. Next up is PTON, Peloton, coming back from the dead. Maybe the reason that this one made the cut is because we have a bullish engulfing bar on the Friday session. Remember, we gapped down. The sellers had their opportunity to take it short off the top of the range. It did not happen. They did not materialize. They were nowhere to be found. The buyers responded firmly and closed the day's range outside of that selling bar high. So to me, buyers firmly exhibiting and sort of flexing their strength, if you will, as long as we're above 1130, looking for continuation to backtest this flush point here around 1250, we'll call it, just for round number's sake. I know the range is not very attractive here in Peloton, but if we can clear that, you can see that's where it kind of opens up closer to 1450. So bullish trade idea here inside of Peloton. Maybe you do it with shares in a smaller account, no big deal, great price point from that perspective. Ideally, this does not fall back down underneath 1130, right? The buyers have flexed here. They need to keep it up now, and we did see good volume on the Friday session. Next up, last but not least, another 3-bar play potentially here inside of 3M company. You can see we've got 1 trend bar, 2 consolidation doji in the upper 50%. If we breach the 2 highs here, target should be up here, right? So 154, we'll call it for round number's sake, is that target on the upside. I would say on this one, give it a little bit more wiggle room here. Ideally, we don't want to retrace all the way to the bottom of this bar, but from a trend perspective, we would still be okay if we formed a higher low off of 144 and over time reattempted this 148.50, right? That would produce the potential breakout after a higher low, something like this, and we can see that continuation. Ideally, from a momentum perspective, this just happens on a 3-bar setup, and we do something like this, right? We get momentum, pause, and then continuation, and the excitement is still there. You'll know if it's still there if volume comes in fairly aggressively early on the Monday session, and it truly will be just a 3-bar setup. That's what I've got for you in today's video. If you appreciate it or learned anything new, let me know down below in the comments section or by giving the video a thumbs up. Don't forget that we will be live on Monday morning at 8:30. Grab a shirt if you're inclined, and I wish you all a green trading week.